The US Federal Reserve has chosen a new chair, and while the pick may not have been widely expected, it is in line with President Biden's stated desire for a more collaborative leadership style. This shift could bring about significant changes to the monetary policy framework, sparking market volatility and renewed speculation on interest rates. The catalyst for this change lies in the Fed's search for a leader with strong organizational skills. The current chair has been under fire from both sides of the aisle, facing criticism over his handling of the 2020 market crash and subsequent economic recovery. A new leader may bring fresh perspectives to the table, particularly when it comes to addressing labor shortages, supply chain disruptions, and inflationary pressures. According to a recent survey by the Federal Reserve Bank of New York, nearly two-thirds of respondents believe that the Fed's leadership style has become too focused on quantitative easing, with some calling for a shift towards more traditional monetary policy tools. This sentiment is echoed in the market, where investors are increasingly seeking guidance from the central bank on how to navigate the current economic landscape. Data points suggest that this pick could have significant implications for monetary policy. The Fed's balance sheet has swelled under the current chair's tenure, reaching over $8 trillion in assets. A new leader may seek to reverse some of these trends, potentially leading to a reduction in quantitative easing or even a reversal of the central bank's dovish stance on interest rates. In fact, a recent analysis by Bloomberg shows that the Fed's balance sheet has grown at an annual rate of 20% since 2020, with the majority of those gains coming from purchases of Treasury and mortgage backed securities. A new leader may seek to slow this growth, potentially leading to higher interest rates and a stronger dollar. Scenarios for market reaction are varied, but most expect some level of volatility as markets adjust to the change. A more hawkish Fed could lead to higher interest rates, weighing on growth stocks and potentially triggering a rotation into value and dividend plays. On the other hand, if the new chair maintains the current dovish stance, investors may see an opportunity to buy into beaten down sectors. However, there are risks associated with this change. The transition period could be rocky, particularly if the new leader is forced to navigate a divided Fed board or conflicting economic data. Furthermore, market expectations may not align with the new chair's vision, leading to a disconnect between monetary policy and the broader economy. Tactically speaking, investors may consider scaling back exposure to growth stocks in favor of more defensive plays ahead of the announcement. A break above 3,800 on the S&P could provide an opportunity to fade into value and dividend plays. Conversely, if the new chair maintains a dovish stance, a breakout above 4,200 on the index could be seen as a buying opportunity. The Fed's new chair may bring about significant changes to monetary policy, but it remains to be seen how the market will react. With over $20 trillion in outstanding treasury debt and a federal budget deficit that has grown by over 50% since 2020, any shift in the central bank's stance could have far reaching implications for the broader economy. Takeaway: the US Federal Reserve's new chair may bring about significant changes to monetary policy, sparking market volatility and renewed speculation on interest rates. As investors navigate this uncertain landscape, it is essential to stay informed and adapt quickly to changing market conditions.